All right. So this is credit derivatives. Financial derivatives. Now is lecture number 4. We began chapter 2 on page 24. 2.1 is also on page 24. Section 2.2 was call options. Calls on page 26. 2.3 was puts on page 26. 2.4 was over-the-counter market. We call it, in short, we call it OTC, over-the-counter market. Page 27. And 2.5 is now organized exchange. For options. So, organized. You see, from chapter 2 to chapter 7, I'm going to be talking only about options. So, here, when I say exchange, I mean options. Exchange, page 28. All right. So, exchange. You guys want it big, right? So, exchange is a legal entity. An exchange is a corporation. It's a corporation specializing in the trading of securities. And an options exchange is an exchange specializing in the trading of options. So, an exchange, again, is a legal entity organized for the trading of securities, same as financial instruments. An exchange has a physical facility. It's actually a building. It's got rooms. It's got offices, okay? So it's a place where the people go and meet. The second part is an exchange will have rules. Everybody has to follow rules, regulations, and an exchange, like any other organization and institution, will have procedures. Procedures tell you how things are done. In a procedure, you're given step number 1, step number 2, step number 3, step number 4. Okay? You can do, you cannot do. The rules tell you what you can and what you cannot do. And the regulations tell you what you have to do. Okay? The next key I already explained is that the contracts are standardized. Given size, given expiration dates, given whatever margin requirements, whatever it is, everything is standardized. And the standardization is described as in contract specification. contract specification is a detailed description of the particular options contract. What it is, when it's exercised, all the little details. When you are presenting at the end about, let's say, the derivative market in Thailand, the most important part about the particular market, whether it's soy or rice, is the contract specification. What's the contract? Okay? It just tells you what it is. The next key characteristic, which I explained with over-the-counter derivative, is that the organized exchange provides for a secondary market. Secondary market. Financial markets are primary, and financial markets are secondary. A primary market is a market where security is issued and sold for the first time. So the primary market is the market where the issuer sells the security to the first buyer. Okay? Secondary market is when one buyer sells it to another. In other words, when one investor sells the security to another. A secondary market is a market where the issuer is not involved. So, is a market between investors. The primary market is a market when one party is the issuer, or the issuer is the seller. Organized exchanges are exchanges for, or is it secondary market? And the big advantage of the secondary market is, what's the advantage of a secondary market?
Liquidity.
Perfect answer. Liquidity. And what is liquidity?
Volume.
No. What is liquidity? Liquidity. That's going to be on the quiz next time, right? Liquidity is the ability to sell quickly close to the market price. Okay? There it is. This guy is a very nice, good, high quality Seiko. It's got sapphire, it's gold plated, it's all the good stuff, right? Is it liquid or not liquid? Not liquid. Can I sell it easily?
No.
You mean no? You mean no one's gonna buy it for 10 baht today now?
Yeah.
Oh yeah. Immediately the guy is bidding. You're not gonna buy it for 20? Hey, it's a high quality Seiko. Just the gold is worth 100. Oh, you see? So it is very easy to sell it dirt cheap. So the problem is not whether it's easy to sell. It's always easy to sell at a cheap, low price. Right? You have a house? Hey, I'll buy it for 1,000 right away. I'll pay 2,000, right? But you say that's not the market price. Liquidity means you can quickly sell it very close to the market price. Okay, let me show you a more liquid asset. All right, more liquid asset will be, well, not this one. Good old, this is a brand new $50 US. Can I easily sell 50 US dollars? I can probably go to any exchange in any mall or any exchange and I'm going to easily get the market price. And I'm sure if I ask, I'll go get close to, if the market price is 32, I'm sure anyone will pay me 30 right now. And I'm going to walk to the street and make 32 a profit, right? So this is highly, highly liquid. Very easy to sell. In the sense of easy to sell, close to the market price. That's the key of liquidity. Close, because I can easily sell the watch, but not close to the market price. And that's a big difference. So that's what liquidity is. Now, getting back to the question of volume. When you want to sell a lot, right? You can sell, let's say, $1 million or 20,000. How we call this property of the market when you say a large volume? How do you call it? Huh? When you can sell a large volume. For example, I can go to a bank and I can easily sell 1 million US dollars, right? And get 32 million Thai baht. Shouldn't be a problem, right? How do you call this property where you can sell a big amount quickly? So, liquidity tells you you can get close to the market price. And the volume is called depth. And the organized exchange, the options exchange, provides liquidity, excellent liquidity, and good depth. Okay? So this one says close to the market price quickly. This refers to how fast you can sell. And this refers to how big you can sell. You know, can you sell 50 tons of rice? The answer is sure, easily, right? 50 tons is easy sell, right? All right, so that's the secondary market. What else we got here? And I already explained, extremely important on organizing exchange is called a closing transaction, same as offset. If you buy a contract and you sell the same contract, so if you got a long and you got a short, you can, because both of them are up against the same clearing house, they cancel each other. That's extremely important. Means you can eliminate risk completely by closing the transaction immediately. Okay? That's extremely important for risk management. Otherwise, you have, with over-the-counter, 2 open transactions and an increased credit risk. Here, risk is eliminated down to 0. When you offset, even if the clearinghouse goes bankrupt, you still have no obligation. Very important problem. All right. All right, let's do here. 251. So, as part of the organized exchanges, the first one is listing requirements. Listing means the ability to trade on the exchange. To list means to make it available to trade. In other words, you participate on the exchange. Not you, the contract, okay? So, listing requirements. So, every organized exchange will have a listing requirement for the product. These are requirements to list the product. So, You want to, let's say, list cotton, you need certain requirements. You want to list copper, you need certain requirements. So the organized exchange will specify the requirements to list. It will provide initial listing. Initial listing is listing a particular security, a particular option to trade for the first time. So every security must satisfy initial listing requirements. Then you have maintenance requirement. Requirements. These are requirements that a listed contract must satisfy. For example, within 1 month it will have at least 100 contracts traded, okay? If they don't trade, there is no need to list it, okay? Or if it's listed, you will not list it anymore. The process of removing it is called delisting. Delisting is to remove the listing of an option, so the option or the security does not trade anymore. So it will provide what's the initial listing requirement, what are the maintenance requirements, and what are the delisting requirements. So we call it delisting conditions. Under what conditions the security will be delisted. These are part of the rules. So you got a listing rules. For an option, it will provide the rules or requirements will provide option series. And let's make sure that I get the next thing right. And option class. All right, let's get down them correctly. One of them refers to the different strike prices, and the other one refers to the different expiration dates. Okay, so all options of a particular class, okay, of a particular class are called the option class. So they are of a particular class. Now let's get the series. And here, option series is with the same class, the same expiration, and the same strike. So the option series will include a call with a strike of 100 and a put with a strike of 100. Okay. Now the option class will include, let's say, option with a strike of 100, 110, 120, 130, 140. This will be the strike. And is going to be January, April, number 1, number 4, number 7. Number 7, July. And each represents an option. Okay? So right now I'm giving you an example of how many options. How many options in this option class. Option class. You got 15 options. 3 with this strike, 3 with this strike, 5 times 3, 15. Okay? Alright? So you got an option class and an option series. Okay? And notice the next thing. These are the calls. So, this is the call option class. So, you got an option class for calls, and you got an option class for puts. And the puts will have maybe same, maybe different. Maybe same, maybe different. The way we write it, on the way you get it on the internet, is like this. I'll delete this. They'll draw here 2 lines. And then we're going to say January, April, July, and these here are calls. And these here are puts. So this is one option class, and this is another option class. Okay? And here you got again all right? And to pick one particular series, here is 100 April call, 100 April put, represents a series. Okay? It's just a name. That's how we call it. Okay? So these are all terms and concepts. Okay, what else we got? 252. Contract size. If it's a futures option or an option on, let's say, bonds, it's going to say how many bonds. Maybe 1 bond, maybe 10 bonds, maybe 100 bonds, maybe 1,000 bonds, okay? If it's stocks, the size will tell you, one option, how many stocks it will buy and sell. Typically, the number of stocks, if it is stocks, in the US, the typical number is 100. So, one call option for Microsoft will buy you 100 stocks. Typically, it is 100 stocks. Okay? So, the size tells you the quantity of the underlying that you can buy. If it's rice, it could be 10 tons. It could be 100 tons. Okay? So, each contract has a size. And when there are stock splits, I'm not going to discuss. I don't want to do this. Number 3. Is exercise price. Every option must have an exercise price. It's very clear. This is the price at which the buyer of the option can force the purchase or sale, depending whether it's a call or a put. That's the exercise price. The tricky part is what happens to the exercise price when there is a, for a stock, when there is a dividend. And usually, today, we don't make adjustment for dividends to the strike price. Because dividend may be 30 cents, maybe 5 cents, maybe whatever it is. Now you gotta change. It gets extremely complicated. So today, modern day stock options do not adjust the exercise or the strike price for the dividend, okay? If it's 100, it's 100. If the price is small, the exercise price is at $2.50. So if the price is like $15, the strike will be $15, $17.50, $20, $22.5. So the difference from strike to strike is $2.50. Okay? If it's a little bigger, it will be $5. So the strike price will be 70, 75, 80, 85. And if the price is very big, like 200, then the difference is $10. So it's going to trade it with a strike of 200, 210, 220. Is that fairly clear? So, strike prices will be either a 250 difference, or 5, or 10. And these are examples. Okay? So, if it's Microsoft is trading at 173, you're likely going to have calls and puts at 150, 160, 170, 180, 190, and 200. Okay? So, it just tells you what's the difference from strike to strike. How far strikes are spread out. Okay? So, the 250 is when the price is less than 25. Okay? $5 it's when its price is less than 200, but more than 25. And here, price is greater than 200. All right, that's the exercise price. Dividend, here we say no dividend protection. No dividend protection. In other words, there is no adjustment of the exercise price when a dividend is declared or paid out. Okay? So that's an exercise price. Number 4, 254. Expiration dates. Practically all options expire on the same day of the month. We call the options by name. We call them January options, or we call them July options, okay? And we also say April calls, or we say January puts, okay? And when you say an April call, is a call which expires in April. But the question is, when in April, right? Okay. And let's see, just to make sure that I get it right, okay, is it expires, let's make sure it's on the third Friday. Third Friday of the month. So it doesn't expire on number 20. It doesn't expire on number 25. It doesn't expire. Now, question. When do expire August calls? August 2014 calls. When do they expire? Date, which date? When? What's going on, guys? What's the date? August call. When they expire? Today is August 24. So, 22. It says third. So Friday what? Come on, guys. All right. Which is the first Friday of August? Which is the first Friday of August? Come on, calendars. Huh? It's August 1, which is the second Friday of August. Number 8, which is the third. 15. So, it expires on August 15. Okay? That's it. So, expiration dates are on the third Friday, and then every 3 months. Every 3 months. Let's explain this. We call it January cycle. Is an option which expires in month number 1, 4, 7, and 10. So, options in the January cycle expire in 1, January, 4, April, 7, July, and 10, October. All right. February cycle. Expire on 2, 5, 8, 11. Okay, we call this a learning process. Now, March. Right, that's fine. All right, so for March is easier. 3, 6, 9, 12. Okay? So, these are called the January cycle, the February cycle, and the March cycle. So, some options. So, an option will have only one cycle. So, an option is either a January or February or March. And once it's chosen, it will be for a long time in the same cycle. Okay? So it's just a January cycle, okay? For example, I'm just picking, but it's correct. Gold in the US exchange is in the March cycle, okay? So it expires in March, June, September, and December, okay? So options will belong to one of these cycles and will expire on the 3rd of the respective month. Is that fairly clear? That's why I put in here January, April, July, and there's got one more, okay? Okay. Let's see what else we got. Oh, last section, in the last part in here, it's very small, it's called leaps. L-E-A-P-S. And the S is small. Means long-term equity anticipation shares. You want me to write it out there? Leaps. Long-term equity, long-term equity anticipation protection shares. These turn out to be amazingly popular. You can buy a call or a put which is 2 years out, which is 3 years out. It expires 2 years from now. It is a perfect tool to speculate on a particular stock, okay? You speculate cheaply, okay? And also is a good tool to protect with a put, to protect an investment portfolio. Your mutual fund, your pension fund, your insurance company, you can use a leap to protect your stock positions, okay? Or you can use a leap not only on a specific stock, but also on a stock index, okay? So these are very good for protection purposes. Let's see what else we got. Position limit and exercise limits. So, 2, 5, 5. Limits. An exchange will provide limits. You can't buy as much as you want or sell as much as you want, okay? There is a position limit. And this is the maximum number of contracts that a person, an entity can have long or short, okay? So let's say position limit 10,000 contracts. You can go long up to 10,000 or you can go short up to 10,000. You cannot go above that. That applies to any institution, any, and all of its related entities. So a pension fund and a bank and all of their mutual fund subsidiaries cannot exceed the position limit. And then have exercise limit. And the exercise limit is the maximum number of shares which an entity can exercise within a certain number of days. Within 5 consecutive business days. So, you may have an exercise limit of 10,000, okay? And you can have an exercise limit of 5,000. So, this week, you can exercise no more than 5,000. If you have 10,000 contracts, you can exercise this week at most 5 and next week at most 5. You can't exercise 7 or 8 or 9. That's more than the exercise limit. Okay? So, if you got more than the exercise limit, you got to spread it over 5 consecutive business days. In other words, over 2 weeks or more. Okay? If here the exercise limit is 2,000, this week you can exercise no more than 2, and next week no more than 2, and next week no more than 2. You got to spread it. If you got 10,000, you got to spread it over 1 month. Okay. 2, 6. I'll go back over. No, I can go over here. 2, 6. Option exchanges and trading activity. I'll give you a break in about 5-10 minutes.